Hello there and welcome to the channel. There are three things that you need to do before investing in stocks. Now it doesn't matter if you've already started investing. You need to think about the principles that I will talk you through in this video. Now please remember, this is not investment advice, so evaluate your own needs before investing. Stick around till the end and I will share with you how I have strategized my portfolio. Before we get started, please also consider subscribing or liking the video, as it really helps get the channel out to more people. The joys of financial freedom. Getting to a state where money doesn't matter. Wouldn't that be nice? Can investing in stocks get you there? Absolutely. But there are three things that you need to do. Number one, define your objective. What is your investment objective? How much risk do you want to take? What do you want to achieve with your investments? Filthy rich investors in the stock market, for example, didn't get that way by investing in low-risk, well-diversified index funds. They went big on a single or a handful of stocks. They had enough conviction on that one stock. Then they may have diversified to make sure their wealth was preserved. If you want to become filthy rich, investing in a low-cost fund will not get you there. On the other hand, if you get it wrong, it could mean that you will become really broke really quickly. So what is your objective? Do you simply want to preserve your wealth so inflation doesn't eat into your savings over time? Do you want some regular passive income into your account every month? Would you rather take a little more risk to grow your money substantially? Would you bet it all and become filthy rich or go broke trying? Are you a risk taker who can handle your entire portfolio and savings crashing overnight? Or would you rather have a peace of mind and not be anxious about your savings rapidly going up or down on any given day? What you decide to invest in will depend on all of these factors, so giving it enough thought is very important. So how do you define your objective? There are two things you need to consider in defining those objectives. Number one, risk versus reward potential. How much risk are you willing to take? Are you willing to lose a significant chunk or all of your savings? Or do you prefer to be conservative? How much reward do you want? Number two, income versus growth potential. Do you want steady income every month? Or would you prefer to invest in a stock that has the potential to grow in value, but doesn't necessarily provide you with regular income? So this is what I think your options look like. On the right-hand side are individual stocks, so you carry higher risk. On the left-hand side are exchange-traded funds, ETFs, or mutual funds. On the top half are growth companies, and on the bottom half are companies that are more suited towards income-based strategies, typically value companies. So let's say you want to become filthy rich. You want the value of your stocks to increase substantially and are willing to take on high risk. Then your target are growth and disruptive companies. Companies on the top right-hand side of this quadrant. These are typically expensively priced. You're essentially buying high and selling higher. Companies that fall into this bucket are companies like Tesla, Palantir, Square, Airbnb, Teladoc, Roku, etc. The next category is on the bottom right. You're still in that higher risk mode where you want to bet your dollars on a single company, but now you want a company that'll pay you good dividends. That is regular income. Targeting such companies are typical value investors, people who like to buy low and sell high. Some of these dividend aristocrats include AT&T, IBM, Coca-Cola, Exxon, Chevron, etc. Then there are companies that fall in between these two categories, like Apple, Google, Amazon, Disney, Delta. They don't quite fit squarely in that disruptive companies list anymore, but given that everything that's happened with the recent pandemic, nor are they pure play value companies. Our third category is on the top right-hand quadrant. Here you want to play it a little safer and invest in a group of companies like an ETF rather than just a single stock. But you still want a growth-based strategies. So these would be ETFs targeting growth and disruptive companies. Some ETFs that fit this criteria are Vanguard's VOO that tracks the S&P 500 index, Invesco's QQQ tracking the Nasdaq index, ARK's ARKK and ARKG, which invests in disruptive companies, and BlackRock's IWM if you'd rather focus on smaller companies like the Russell 2000 index. Now Vanguard's VOO and BlackRock's IWM aren't strictly purely growth companies. They also include value companies, but a majority of their portfolio is focused on growth. Finally, we have the bottom left quadrant. Now this is where you want to play it safe through a well-diversified ETF and you want regular income through dividend-paying stocks. So these are ETFs like Vanguard's VIG, VYM, Schwab's SCHD, or BlackRock's DGRO and HDV. Next question. Do you understand the company? Now here are 5 things for you to consider. What does the company do? How does it make its money? What does it produce or what services does it provide? What are its competitive advantages? How does the industry work? Now let's say you're looking for a growth company or a disruptor. Is its revenue rising rapidly? If yes, it may be an indicator that people are very interested in its product. So then are they able to scale up to meet that demand? Does it have competent management who are experienced and passionate with a clear vision for what they want to deliver on? Is the company actually generating cash? Look at the key metrics such as free cash flow being positive or close enough to being positive. Does the company have high levels of debt? For example, is its operating cash flows significantly lower than its debt? Finally, look at TipRanks. That's www.tipranks.com. I find this to be a great website for analyst and expert views on the 1-year price target. Finally, my third question. You've got to work out your strategy for how much you want to invest, the timing of an entry, and timing of an exit. So do you invest all your money in one chunk or periodically? It goes without saying that you should only invest what you can afford. As a guide, I'll always keep around 3 months worth of expenses as cash, so I do not need to sell my stocks at a discount in an emergency. So do you invest all your money in one go? Or do you invest it in phases over a period of time? That is dollar cost average. Now, investment company Vanguard did a comprehensive study on this, looking at US stocks over an 80+ year period. While intuitively you think investing in phases over a long period in time might be a better strategy, what they found was quite the opposite. They found that a lump sum approach achieved better returns 2/3 of the time compared with investing in equal installments over that 12-month period. What's more, the longer the dollar cost averaging period, the higher the probability that lump sum investment outperformed. If the cash was deployed over a 36-month period instead of 12, for example, the lump sum approach won 90% of the time. Now you have to decide what's best for you. Personally, when I started, I decided to invest half of my war chest in the first 2 weeks, a quarter over the next 1-month period, and the remainder over a 3-month period. Should I have kept more money on the side for another crash? Sure, I could have. But time in the market is always better than timing the market, so I'm pretty happy that I'm fully invested. One other point that I want to make is around exit strategy. Now imagine that you're betting on your favorite car to win the race. It's right up there leading the pack. But then suddenly something goes wrong. There's a steering problem. And your bet falls to the back of the grid. What do? Do you double down and put more money on it? Or do you count your losses and cash in whatever you can get? Well, your best bet might be to cash in while you can. On the other hand, just because your stock price is down doesn't mean that you should sell it. Stocks go up and down all the time. It's when there's a structural change in the business. For example, its business model is no longer viable. There's a new, better competition in the market. It's not generating enough revenue that you'd expect. Then you've got a problem. When that happens, it's perfectly okay to sell at a loss. This is not easy. The human brain is not wired to lose money. But sometimes it's better to sell at a loss, reinvest that money into a better stock, than carrying on and hoping for the best. So now, as I promised, how have I strategized my portfolio? Let's go back to our strategy grid and let me show you where my stocks fit in. I am a growth and disruptive company investor. Most of my investments are in disruptive companies. I do have a bit in value companies, but that's there more as a post-pandemic reopening play. I also have a bit in ETFs, but to be honest, that's just money parked, and I intend to sell that off and reinvest it in one of my disruptive plays at the next crash. So here it is. Amongst my disruptive investments, my biggest play by far is Tesla. I'm massively bullish about this company. It was significantly higher a proportion of my portfolio, but the recent FUD around it has pushed it down to just under 2/3. I also invest in financial disruptors Square and SoFi. Having seen what Chinese financial disruptors like WeChat Pay and Alipay have done in that region, I am massively bullish about what these two can achieve in the US and globally. Then I'm investing in chip makers like Nvidia, AMD, and a small proportion of my investments in Qualcomm for its 5G play. I believe these companies should all benefit from all this technology transformation that we're seeing today. My next group is data analytics companies. Palantir is my main play given its unique product, but I also have a small investment in Alteryx. Genome is the next group with an investment in Teladoc, Illumina, and Invitae. I intend to grow some of these investments in the near future. Virgin Galactic is a purely, wildly speculative investment and, to be honest, just a bit of fun. Finally, I've opened up positions in some Chinese disruptive companies, Alibaba, Futu, and Tencent. These companies are under a lot of regulatory pressure at the moment, but they have some really interesting business models and market shares that will be the feature of a future video. So in addition to my disruptive companies, I have a small position in QQQ, and as I mentioned earlier, it's more of a parking spot for my cash before I transfer it all onto one of my disruptive stocks. I also have a small position in Delta and HSBC, which are again simply reopening plays. I do not believe in the long-term futures of these companies, and I intend to sell them off in the next year. Well, I hope you found this video useful and my tips helpful. If you did, please consider subscribing and smashing that like button and leave a comment below. Thanks again for watching and look forward to having you at another one of my videos.